Morning, everybody.
Recording in progress.
I'd like to open the call to order for Governance Committee for Wednesday, May 14th.
Sir. Thank you, Mr. Green. This meeting is being conducted as a virtual and in-person meeting, so I will do a roll call of trustees to confirm attendance. Mr. Green?
Here.
Ms. Ginsburg? Here. Ms. Langton? Ms. Martinez? Mr. Jones? Okay. Staff participating in the meeting include the following: CIO John Grable, Deputy CIO Drew Perez, PIO Scott Drazel, and our guest speaker for today is Jen Sison, Chief Executive Officer of ICGN. Trustees, please use your raise your hand option to be placed in the queue. At this time, we ask all meeting participants to mute their mic until you're ready to speak. And now we will proceed with the agenda.
Thank you. P449.
Nothing.
Excellent. No pledge of allegiance. Okay. Approval of the minutes. We need a motion.
Okay. You want to make a motion?
Yeah, motion to approve the minutes from last week.
Okay, we need a second.
I'll second.
Okay. Mr. Green?
Aye.
Ms. Ginsburg? Yes. Mr. Jones?
Aye.
Okay, the motion passes unanimously.
There's two copies.
So you were on this one.
Oh.
So that's the corporate governance. So the next page.
I got you. All right, excellent. Thank you. Any public comment?
None.
Excellent. So we'll go with item 5. We have a report and a presentation. Mr. Drazel, would you like to make an introduction?
Yeah, absolutely. Great. Thank you and good morning, Chair Green, trustees. For today's committee meeting, we're pleased to have a guest speaker. The committee might recall that a year ago, we hosted the executive director of the Council of Institutional Investors, or CII. CII works to promote good governance practices and prudent financial market policy in the United States. Today, we're going international. We're going to go global, and are pleased to host Jen Sison, who's the Chief Executive Officer of the International Corporate Governance Network, the ICGN. LACERA has been a member of both. And like CII, ICGN focuses on promoting good corporate governance practices across markets. The LACERA portfolio is international. We're invested in over 6,000 publicly listed companies in over 60 global markets. So we've worked with both ICGN and CII to encourage good governance practices globally. About a third of the value of our global equity portfolio is outside of the US. Also like CII, ICGN is celebrating a milestone this year. CII marked its 40th anniversary and ICGN is marking its 30th anniversary this year. So it's a great moment to hear some updates from Jen on current areas of priorities and focus and some trend lines. But before I give a few more comments about Jen's background, we've got 2 brief slides here to provide some context for trustees on our approach at LACERA to corporate governance and how that applies across the portfolio, across global markets. So we'll just start with slide 3 quickly, which of course, as trustees are aware, our focus on good governance is driven, rooted in, motivated by our mission and our fiduciary duty to generate and safeguard returns in order for us to be able to pay benefits. Fund policies recognize that governance failures can cost money, lead to investment losses, but good governance practices can also instill confidence from investors and make us comfortable to place money with companies. So the board has established our corporate governance principles. They're organized into 5 very high-level guiding tenets. They're listed across the bottom here. That includes, encouraging clear, reliable, comparable information on companies' financials and performance reporting so that investors can assess and price risk accordingly. Includes encouraging aligned interests between investors and CEO pay incentives so that we're encouraging pay for performance by the executives who are running the companies in which we're invested. And critically, I want to highlight that these 5 guiding principles in our overall policy, they apply to all markets. So that first principle on accountability from directors, we encourage the supermajority of boards of our portfolio companies to be comprised of independent directors, no matter what market we're investing in. So whereas in the US, about 90% of the average board is comprised of independent directors, some markets it's still a minority of the board. In Japan, for example, it's still a majority of inside directors, but from the work of investors and associations like ICGN, we've seen some movement, and now there are a few outside directors on boards, and that trend line continues to expand. Similarly, on robust investor rights, we encourage equal voting rights. 1 share of equity in a company should equal 1 vote. And we have seen some movement back and forth on that front across global markets where companies do have weighted voting rights, by which founders provide 10 votes per share, for example. More IPOs are having provisions by which those weighted voting rights will sunset. However, some stock exchanges Singapore, Hong Kong, are liberalizing and enabling more weighted voting rights. So our work with ICGN can be a pivotal part of trying to encourage good governance practices. So how do we apply those principles? Of course, we're voting proxies. We're engaging regulators and stock exchanges, the SEC and other financial securities regulation entities in different markets, and of course through affiliations like CII and ICGN. So it's with great pleasure that we welcome Jen to today's meeting. Jen comes to the ICGN previously with Goldman Sachs, where she headed up investment stewardship for Europe, the Middle East, and Africa, and previously also served with the Financial Reporting Council in the United Kingdom, as well as PwC. She's agreed to join us virtually since she's got a bit of a hectic travel schedule. Was recently in Istanbul and Madrid and is back in London, but we made the time work for today's meeting. So thank you, Jen, for joining us. And she's also agreed to leave some space for Q&A at the end. So over to you, Jen.
Well, thank you very much. And thank you all for having me. One of the great joys of my job is to get to talk to our members all around the world, and it's a great opportunity to meet you this morning. So thank you. So I wanted to talk a bit today about what we're focusing on at ICGN and why we think it's important, and what we're doing on your behalf to try and really advance best practices in governance and stewardship. So perhaps we go to the next slide. Scott has rightly noted. Oh, we're good. Yeah, well, we have an agenda, you can see that, but like we were established in 1995, and actually ICGN started its life as a committee of the CII when institutional investors over there in the US started to get interested in how to vote around the world and how to influence good governance practices outside of the US. And we have subsequently grown to have over 300 members, responsible for over $90 trillion all around the world invested. We are largely pension schemes and asset managers, and we have various other sort of industry participants, much like the CII does, who are interested in good governance and stewardship. And really, we are focused on doing 3 core things. First of all is trying to have some policy impact. So ICGN does not do individual company engagement. So we don't organize collaborative engagement with companies. But what we do is organize our members to engage with policymakers, with governments and regulators around the world to work on the right systems and frameworks that we would want to have in order to have good corporate governance. And we do that in a way that we try to keep very politically neutral, very consistent globally, much like your expectations are global. What is good governance and why it is important everywhere. Capital is global, markets are local. And so we try to find ways to take a similar approach, being mindful of those local nuances, but really bringing our global view. So we're able to say, you know, we have US pension schemes, we have the Japanese government pension scheme, we have people from all over the world, all the continents, in fact. And so we all think these things are important, and that really does add to the power of the message. We try to stay focused on education, on talking about why this stuff is important, and I'll cover that in my presentation today, really with the mindset of we are long-term investors. We're typically very widely invested, and so we need this stuff to work everywhere. Then the other things that we do include networking. So we have a number of conferences every year. We have events to bring members together to share best practices and to learn from one another. And we have an education program which is focused on newer members of our industry in the earlier part of their career, but also on corporate directors. So, for example, in Japan, it was just rightly noted that, you know, independent board directors are kind of a new thing in Japan. And so the people in those jobs really benefit from hearing kind of what is the investor expectation there for an independent director. So we do a bunch of education work. And we focus our work very much on the G part of what we used to call ESG, I guess. But the governance, G is key. That's my catchphrase, right? We say this is the important thing, and we work in 4 areas. So strong and effective boards, protecting shareholder rights, reliable reporting, and best practices in stewardship. And we kind of try to keep all of our work focused in those areas which we know are super important to our members. And those are, I note, very aligned to your key priority areas in your policy there too. If we could go to the next slide, please. Like, sometimes I get asked, why do you keep saying G is key all the time? And so I kind of have a little elevator pitch that this is what I would say. And that is that, you know, good capital markets with strong shareholder rights are enormously important. They're important for society, but they're also important for us as investors, right? This is how we get capital to businesses. This is how we generate returns. And, you know, if everybody is looking for ways to attract investment and to feel confident investing, we need to have strong standards. We need to have transparency. We need to have the right rights to build confidence in global markets. And so ICGN thinks this is absolutely the right way to do it. And really, that's what we're talking about, which is what is corporate governance really and stewardship. It's about the contract between us as investors, who are typically a minority investor, right, and very widely invested, and the management team on the ground who spend all their time on one company. How does the board of directors sit in between that, representing everybody's best interests, and how do you get that to work well? So that's the kind of reason behind what we're doing. And then I think if we go one more slide forward, just to put a bit of color on that, you know, governance issues are absolutely fundamental business issues. We think they're drivers of long-term returns, and we know that they can help to create growth and also to preserve value. And they can do that, as was noted, through risk mitigation, right? So we know there are plenty of scandals we can all think of and issues where companies have lost value because of governance failings. But also, you know, they can be a great driver of good value creation, and they can ensure that our rights as investors are protected. So things like thinking about who's on the board, how are they setting their strategy? Are they getting their capital allocation right? You know, is management well incentivized, aligned to our long-term best interests as shareholders? These are really important governance issues. You know, some of these things are not always the most glamorous issue. Like, people can sometimes laugh at me when I talk so much about audits, but, you know, these are really important. And this is about the core information that drives the capital market, and the role of the board and the role of good regulation and good standard setting to make sure we can rely on that data as investors is absolutely critical. So that's why we keep a lot of focus. And, you know, if we go one more slide, we know that there's value add here. There's, you know, I could make hundreds of slides demonstrating why this stuff adds value and protects from risk, but I just pulled out a couple here. This is some MSCI research that looks at companies considered to be US corporate governance leaders versus companies that don't have such good corporate governance. And we can see clear outperformance here, right, over time. And you know what? There are some companies that have terrible corporate governance that still perform really well. And that is true. But generally speaking, on a system-wide basis, we can see that there is a value add here from good corporate governance. And if we go to the next slide, you can also see that, the things that really matter are really fundamental, important, core corporate governance issues. This is not particularly controversial stuff. This is basic good business practices, good shareholder rights protections. And so there are a number of studies here that say, actually, here there are these 6 factors are things that we're going to vote on all the time in our roles as investors, and these drive a lot of that governance value premium. And you can see that's things like staggered boards, right? So that means, does everybody on the board get elected every year? Or can you only vote against the directors, say 1/3 of the directors each year? And that just means that you have that little bit less accountability as directors, and it can lead to some less good outcomes. So these would be the types of things that Scott and the team think about when they're voting. Similarly, things here on like ability of shareholders to vote. These are very basic protection corporate governance issues that are known to drive long-term value creation and risk protection. And this is not just true in equity returns, because we all know we're invested a whole bunch of different ways. So if we go to the next slide, this is a study that looks about cost of debt and credit ratings. And we see here that strong corporate governance scores generally tend to correlate to better credit ratings for companies. So we can see that these are issues that are important to us, both in our public markets investments, also in private markets investments, and in fixed income too. So I just wanted to, and this is a less cheery slide, but if we go to the next slide, you know what, there's also the big risk factor here, which is that when it goes wrong, it tends to go wrong spectacularly. So these are some quite exciting examples, I think, of where we have some pretty famous corporate governance failures. We won't go into a great amount of detail here, but if we think about Enron, Tyco, ENRC, which was a mining company that had a lot of problems with related party transactions that led to huge value destruction, Dieselgate in Germany. So while we are optimists and we look for the positive side, we also should be mindful of the risk management importance of good corporate governance in our role as investors. So if we keep going, so given that all of that is true, we work across these 4 areas because we think these are the core G factors that are important. And so on your behalf and on behalf of all of our members, we really try to focus on policymaking and systemic issues where we think we can have broad-based impact here. So for example, if there's going to be Companies Act regulations around the world that govern how boards have to be set up, listing rules, which would cover typically things like the types of shares that companies have to have. What do you have to have a vote on? These are the types of legislative proposals and government codes that we will engage on. Reliable reporting, we're going to talk to this later, but things like accounting standards, auditing standards, sustainability reporting standards, we think this is super important, and we are there to lend the international investor voice to some of those developments. Shareholder rights, nowadays, this is very focused on annual general meetings and voting access, and we'll talk about that in a little bit more detail later. And then best practices in stewardship. So what should we do about all of this as investors? There are a number of stewardship codes in the world. There are obviously needs to figure out how to best manage some of these things, and so we try to lend our insight and be a forum for people to share ideas there. All right, so we'll get in a little bit of detail about what we're doing now, and then I'll pause for some questions. So on shareholder rights, this one's really important, particularly for global investors, because I sometimes think we forget, and people forget sometimes too here in the UK, that the way that the markets operate in the US and the UK and large parts of Europe isn't really true everywhere. And so there are things that we can be working on to try and improve our shareholder rights. So multi-class shares can be a real challenge. If you end up with a founder that has 10 votes for every share that they own, and we only have one, that can make it very difficult to hold them accountable or to make changes or to express dissent. And so we work alongside many other organizations, including the CII, through the Investor Coalition for Equal Votes, and advocate that companies should be really, really careful about allowing these types of structures into their markets. This is mainly common in sort of very high growth, exciting tech companies. But because those companies are exciting, lots of companies want to copy that, right? And so we start to see certainly many private equity exit companies really starting to push governments around the world, here in the UK, across Europe, in Japan now, to consider loosening the rules. And so we want to try and advocate for keeping our ability to vote. Accessible annual general meetings is a real worrying trend around the world, and it's one that we're doing a lot of work on. So post-COVID, there's been a real shift in how company meetings work. So it used to be that if you wanted to go to a company meeting, you kind of had to go. You had to jump on a plane or drive and find the building and turn up. And then, in the pandemic, a lot of companies moved their meetings to be virtual meetings to allow for participation when that wasn't possible to do in person. And in an emergency scenario, that was the right thing to do, right? But what it does do is take away some of the protections that you would normally have as a shareholder. So, for example, if they don't, if they don't call on you on a Zoom, you can't ask your question. Whereas if you're in the room in real life, you can line up behind the microphone and stand there until the chairman lets you ask your question, right? So there are a few things we don't always know that we have the protections online that we might otherwise have. And so IC generally advocates for a hybrid model. So there are lots of benefits to widening access through virtual participation, but having some people in the room and having that ability to really interact with the board and make sure that their questions are asked is super important. Unfortunately, there are some places in the world where the annual general meeting is almost impossible to attend now. So lately in Italy, companies have been allowed to nominate one shareholder to represent all the shareholders at a meeting, and otherwise hold that meeting behind closed doors. And really then there's a risk that we just don't know what's happening at all. And clearly that's a worrying thing for shareholder rights. So we've been doing a lot of engagement to try and change those things. And the final thing on this one I'd note is in many markets, it's actually quite tricky to vote. And this is getting better and better around the world. The rates in which people have been able to vote is going up and up, but there are still some markets that have kind of funny rules about how you can cast your vote, right? So there's something called share blocking, which basically tries to place restrictions on your ability to trade stock in a certain period in advance of the meeting. And so this causes all kinds of trouble. Similarly, there are markets where you have to have power of attorney from all your underlying beneficiaries. And so these are just barriers that make it very difficult for us as institutional investors to exercise our votes. And we really try quite hard to get rid of those barriers. And this is a big project for us in the European Union at the moment, as we expect a new shareholder rights directive. And apologies for throwing a bunch of governance jargon at you. Happy to unpack any of that if it's helpful. But I think the thing to remember with this is, we don't want to have to vote against people, but sometimes we need to. And sometimes you do need to be able to ask a question to a board of directors and show up in the room and make sure your voice is heard. We just want to make sure that those protections exist, because we know that where they do exist, that drives good governance behaviors that we saw in the earlier information there is good for us as long-term investors. So if we go forward one more slide here, and this is just a little bit further detail for you, but there is a great organization that we participate in alongside the CII and yourselves and many other investors, called the Investor Coalition for Equal Votes. And so this is really about trying to encourage companies not to use these problematic structures, because once they're in, they're real difficult to get rid of, because you've entrenched a position where you don't have as many votes. So if this is something that is of interest, I recommend a look at the work of the ICEV, the Investor Coalition for Equal Votes. It's very, very interesting and being very, very successful, particularly in getting companies to do something called sunset these dual class shares. So you can have them when you're a brand new company, but then after 7 years, you've got to go back to a different one share, one vote system. And that seems to work quite well. All right, so then we're going to move on to our other area of focus that I hope is exciting and interesting, and that is reliable reporting. So, it is our view that if an issue, a risk or an opportunity or an impact is material to a company, then the board should make timely and reliable, transparent disclosures so that investors can have that information. There are a whole bunch of different reporting frameworks and initiatives happening all around the world. But it is our view that as long-term investors, the absolute fundamental thing is this important information for us to know as an investor? Is this material? And if it is material, you should report it. And that is our guiding principle in this work. We also need to be able to trust the numbers. So we need it to be appropriately assured or audited, and we need to have good standards so we know that we're comparing apples with apples. But we are mindful that we have to balance costs, right? Reporting is not free. Many companies have very large teams working on their financial and sustainability reporting. And so we don't want to ask for information that isn't needed. We want to be thoughtful and balanced. And so we try to keep that financial materiality as the guiding principle in what we're asking for. But we do believe that what is material is broader than what many companies currently report. So if you go to the next slide, it's likely that you may have seen this before. This is quite a famous diagram now in many ways, but the value of a company is driven far, far more by intangibles nowadays than it is by fixed assets. So it used to be, if you go back into the 70s and 80s there, that you can tie the value of a company to sort of machinery or buildings or products, right? But we now know in the modern world that intellectual capital, technology, these things are often very, very much bigger part of the valuation of a company than the fixed assets themselves. And so we need to think about a broader range of inputs to our investment analysis, right? That might be important when we're thinking about what's driving that value. And those will often be called ESG factors, sustainability related reporting factors. Clearly, climate is a very important part of this as we think about it as investors. And so we are very focused on driving standardization and adoption of the international sustainability supporting reporting standards. So I only have 2 more slides, and then I promise I'll stop for questions. So if we can go to the next one. There are a bunch of models for this in the world. Our view at ICGN is that the ISSB model is the best way forward. We think it's pragmatic. We think it builds on the way that investors do their work. So it takes the SASB standards, which are the Sustainability Accounting Standards Board. It takes the TCFD, or the Task Force on Climate-Related Financial Disclosures, and integrates those with the integrated reporting model and the Climate Disclosure Standards Board to make one framework. They're trying to get rid of what we used to call alphabet soup, right? There's too many acronyms in reporting. We need to simplify this down and say, let's have a global baseline of financially material information, and let's get everybody to report on the same framework. We'll let companies decide, is this material or not? And if it is material, we're going to talk about how to report it. So very much the same mindset that you use when you do traditional financial reporting. We think this is a good way to go. We've been big supporters of trying to get these standards adopted on a mandatory basis around the world. It's worth saying there are some markets where mandatory adoption of these standards is very unlikely, right? And so what we would do there is encourage voluntary adoption and support the work of many different organizations in getting companies to do this on a voluntary basis. But my last slide is to show you how broad this is, right? So all of these organizations here are relevant stakeholders that need to be engaged and need to hear from investors about why we need to have this sustainability, financially material sustainability related reporting, right? And this is not even all of them. And so this is a really big project. We need to be coordinated. We write a bunch of letters, but pretty well all the stock exchanges, all the securities regulators, the international standard setters, the European Commission, the OECD, these are all organizations that we engage with on your behalf to try and push this forward because we think it's really important. But yeah, so if you ever follow us on LinkedIn and you see that we've written another letter about this, that's because there's a lot happening. So we try to keep across everything around the world to be consistent in our approach as much as we can. So that's kind of a little overview of what we're up to here at ICGN, and happy to take any questions.
Anybody have any questions or comments? Well, David?
Thank you so much for this presentation. Can you go over slide 7 again in a little bit more detail, or go
over? Yeah. So basically, what is slide 7 is about a study that was looking at what are the factors that would indicate poor governance. Okay, so this is Lucian Bebchuk at Harvard is a very famous academic in the world of corporate governance, right? And so what this study was basically saying is, can we tell, because if you look at a governance rating that you get from a third-party rating agency, there are hundreds of different things that go into these analysis, right? There's all sorts of different things. Can we tell any individual elements that are more likely to show a risk that bad governance will impact returns? And what they found was there are these 6 governance provisions that companies have that can be particularly harmful. And so that kind of drives a view from many investors and from ICGN that these are not a good idea. So, for example, having a supermajority requirement for voting on things like amendment of company charters just means it's basically very difficult to do it. So we would therefore argue that 50% plus 1 vote, that ought to be the goal for good governance, right? Because if you have supermajority is often 75% vote, that's actually pretty hard to achieve in many cases. And it can entrench these sort of difficult, if management don't want to do something, it's pretty hard for us as shareholders to force them to. Similarly, poison pills, or these are mechanisms that are designed to make it difficult for investors to oppose things like acquisitions or buyout offers and various different things.
Yeah, actually, can you go over each one of them, since you already did 5?
Oh, sure. So staggered boards are boards that all of the members of the board aren't elected on the same time frame. So let's say you have 10 people on the board. A staggered board has say 3 of them up for election 1 year, 4 the next year, and then 3 the year after that. But so what that means is that your compensation committee chair isn't on the ballot every year. So if you're angry about how the executive compensation structure works, you can't necessarily vote against the director who's responsible for that in any given year. Or similarly, if you have an audit problem and your audit committee chair is not on the ballot that year, it limits your ability to register that vote. And so it's better in most cases for companies to elect all the directors in one go. Now, this is very varied around the world, but that's just this is a US study. And so, but generally speaking, we would agree with that.
It's better to do it in one time? Or
yeah.
Staggered is bad?
Staggered is bad. because it means that you can't always vote against someone if you want to. So it basically means that they're likely to be elected for, say, 3 years at a time. So if you get elected in 2025, you won't be on the ballot again until 2028. Whereas an unstaggered board would have everybody up for election every year.
And to tie these comments back to LACERA's policy and how we operationalize them, the LACERA corporate governance principles do call on where we are investing, providing equity to companies, that directors should be up for annual election. We discourage boards from adopting poison pills. If there is a competitive offer to acquire a company, we think investors should have the right to review and consider, is that in our economic interest or not? So if there's a compelling reason for a poison pill, that poison pill should be put up for shareholder review and a vote. So our principles have long been in line, with these provisions, a lot of which came out kind of almost in the mid-'80s when companies were reacting to takeover bids and reacting by trying to lock the doors, basically. So particularly where there's a combination of the factors, it can particularly insulate, boards and management teams from scrutiny and review by us as providers of capital. So this is just one of a variety of academic research that sometimes we'll be reviewing and trying to understand what are the implications for good governance practices that we can advocate in different markets, particularly as providers of capital to a company. Now, a nonprofit might have a different board structure. That's not what we're necessarily talking about here. A private company might have a bit of a different lens, but where we are providing equity to publicly listed companies, these are considerations that have long informed our principles.
So these principles are for, it applies to our pension fund too, or is it more for the people we invested?
These apply to where we invest in public equity companies, and certainly considerations for where we're invested in a private equity firm, what we encourage good governance practice to be when that firm exits possibly as an IPO.
But not necessarily for us as a pension, because our pension is a little different.
Correct. No, not for you. Not for you as a pension scheme.
Okay.
This is just for you as investors. So for you, if you're going to invest in a public company, you ideally do not want them to have these 6 things, because for each of these 6 things they have, it just slightly decreases your ability to hold the board accountable and to exercise your rights as shareholders. And so the more of them you have, just like Scott said, right, it compounds as an issue. So this is just good examples of things. So we talked about those limits to bylaw amendments. Is like, are we able to suggest changes to the way the company is governed? And then golden parachutes is essentially big payoffs for failed executives.
Just to be clear, the only thing that applies out of this entire list is staggered board. To us, it has no bearing on us. That's part of policy dictated by government code.
Yeah, and it would, listen, it's not uncommon for companies, organizations that aren't public companies, to have a staggered board. ICGN has a staggered board because in a not-for-profit, right, you actually need sometimes tenure, right? So I need my board directors to stick around for institutional memory, right? But I don't have shareholders who might want to vote them off the board necessarily. So you need to have a governance structure that suits the type of organization.
And for some market context, in the US, these practices are no longer very prevalent. Maybe 20 years ago, there was a large number of large cap companies that would have a number of these provisions, including staggered boards. Now for a large cap company, it's well under probably 5% of markets. LACERA, 8 years ago, Dale Johnson worked with other public pension plans and CII to file shareholder resolutions, particularly asking large companies to move on. To Jen's point, the rationale for some provisions are to provide stability and continuity at companies. Perhaps that is a rationale. Research like this will indicate that over time it can have an entrenching dynamic that can deteriorate value at the company.
Thank you, Mr. Drizzle. Ms. Mee?
I have two questions. First of all, thank you for presentation, both Scott and Jen. Piggyback on this slide that we have in front of us, I'd like to hear your view about how is this helping or preventing activists? What do you think of activists?
Well, where some of these things exist, they are activist defense mechanisms. That's why companies have them. Again, that was a thing kind of a lot of the time, a long time ago in the US. We don't really see this as much necessarily in the US and the UK as we used to, but a lot of these things are pretty common in some emerging markets. As activist defense in parts of Northern Europe, we see a lot of this happen. I think that not all activists are the same, right? And so there are some markets, and it's very interesting if you look at Japan, for example, where what activist investors are asking for are pretty basic corporate governance asks in other markets. So they would, they are activist funds and they are trying to make changes to release value, but the changes they're making, if that company just lifted itself up and existed in the US, would just be standard market practice, right? So there are instances where governance is used as an activist lever that are not short-termist at all, and that we would completely agree are in the long-term best interests of, the theory of corporate governance. So it's a little bit difficult to make a kind of general statement about whether activism is good or not. I think in many cases, yes. And governance is increasingly a lever, particularly in Asian markets, and actually also in continental Europe, we're seeing more and more governance-based activism as well.
Thank you. Go ahead. You have something to say?
Trustee, maybe just add to the question of impact, something like the ICGN's work on encouraging accurate financial reporting. We have seen improved practices in the US, which have led to a significant decrease in financial restatements, for example. So hopefully that's a signal that financial reporting is more reliable. Jen also mentioned work to remove barriers to voting our proxies in different markets. When and where we can't vote is now under 1% of our voting shares. 10 years ago, when we tried to vote, there would be every kind of step in the chain, the custodial chain, to vote for a company where we were invested in would add a few days to the time frame or another deadline, which meant that literally at times the vote deadline was before the company's reports were even published. So we would be required to vote on something before being able to see the reports. The work and collaboration of investors in different markets to address those time lags or regulatory impediments like we are blocked from trading shares in the interim have been significantly reduced. So those are maybe two concrete examples. Hopefully the broader approach, and this is based on the board's principles and policies and affiliation with ICGN, is hopefully encouraging good market performance as detailed in slide 11.
Thank you. Speaking of voting, this is my second question. We talked about equal vote earlier. So help me understand, it's quite a common practice in at least US stock market. We have preferred stocks, we have common stocks. Preferred stock is not just equal vote, there's no vote, right? So what do you think of that? And then second follow-up question of that on our investment, LACERA investment, do we invest in preferred stock at all or only common stock?
Jen, would you like to take it first and then I'll follow
up? Sure. So really, what we are talking about is voting stock, so stock that carries voting rights. So companies have all kinds of different structures that they can use. But the real issue is where you would have like A shares and B shares is how they're often described. I think the slide 12 is probably pretty helpful here. So for example, if you buy a share of stock on the stock exchange, oh, sorry, it's 12 in my deck. Yeah, there we go. You might get 1 vote for your share, but if you were the founder, you would get 10, 20, sometimes 50 votes. And so what that means is the vote outcome at the end of the meeting might be, 70% for the motion, 30% against. But if you equalized, so everybody had 1 vote, then the motion would have failed. And so we don't think it is a useful thing to do. Now, it is a kind of pretty popular thing, particularly for founders, to say, well, I want to access the public markets. I want to be a public markets company. That's going to be good for my company. It's going to be good for, the economy generally. But I need to maintain control of my company. This is new. This is precious. I have got a lot of work to do here to drive it forwards. And so they want to maintain control. What research shows you is that after about 7 years, there is no benefit to the founder being entrenched in maintaining that control. So where companies do want to have these supermajority for founder protections, our view and the view of the Investor Coalition for Equal Votes is that you should sunset that after a period of time. So after 7 years, you should let everybody vote. Should we switch back to a single share structure, or shall we leave it how it is? And do that on a simple majority, 1 share, 1 vote basis, because maybe the investors are fine with it, and that's okay. And people should have a vote. There isn't always a right answer that's the same for everyone. But generally speaking, we do think that's the right way. And it's just because it's very hard to hold any kind of accountability in a multiple class structure. I don't know the answer to the second part of your question, but my guess would be, given you're very broad investors, that you invest in all sorts of different companies. And so that's why we have to focus on these things. Scott?
Yeah, Scott, if I may, Jen, thanks a lot. You nailed it. I was just going to say something with the dual class structure. So we do see it. We see, and it's not just in a public market, but if there's a, fund manager that, had something come up exactly like Jen said, this is their baby and they're going to handle it with kid gloves. They're seeking limited partnership capital from us and other places. But they want to carry it through, but by contractual agreement, that sunset clause is, so they're able to carry it. We set our standards and say, okay, this is fine. If they break it off, or if it grows or it has a threshold, and Scott can talk about whatever the metric is, even in time value, then it becomes equal voting rights for us. So that's really the workaround for it, but it is absolutely important to have equal voting rights. But we will see it if people seeking capital, and but we apply our own policy and methodology to it.
Thank you.
That's
Maybe I
great.
can make my question clear. I'd like to understand the preferred stock. What do you view of it? Preferred stock doesn't have any vote, right?
Yeah.
So I'll add that typically for public markets, the common shares are what's listed. We have advocated with the board's policy 1 share, 1 vote. We're encouraging through our participation with this ICEV coalition that when and where companies do have weighted votes, they have a sunset provision. And typically recent years, at least 50% of IPOs have had some type of sunset provision by which investors can vote, or perhaps if the founder departs within 5 years. On preferred shares, we could have preferred shares throughout the portfolio in a few different areas in terms of exposure. But we have also seen the rise of some companies authorizing the board to issue preferred shares with providing the board discretion on allotting the voting rights of those shares. And that has raised a concern of if that's a backdoor mechanism to have a weighted voting structure that is in the hands of the board. So CII recently adopted an expanded policy that one share, one vote should apply to all voting structures and not provide an opportunity for like a backdoor preferred share voting with discretion to the board to allot weighted voting rights. And we've supported that in line with our principles for equal voting rights. So a bit of a nuanced question to answer to your question.
Thank you all.
Okay, great. So for the sake of time, I want to move on. I want to, as Mr. Jones would say, take a chair purview here. Anybody else have anything quick? We got to move on and get to our other agenda. But Jen, thanks so much. I really appreciate this. I want to highlight some things. ICGN and CII, why it's so important, the work being done. It empowers limited partners like ourselves and others, especially globally or domestically, to really maintain our investment intent based off our policy or our government code, and set our expectations for these fund managers to align with that policy. And I think that's really important work. I mean, it's noble in a sense. And I mean, dealing with an international market, I can only imagine, the different areas. Yeah, like I said, when we're, kind of an overwatch too and dictating policy. Once is a mistake when we're looking at managers. Twice might be a coincidence, but 3 times you have a problem, right? So, and like Scott said, we reiterate 6,000 companies in 60 markets, right? That's incredible, for as far as LACERA. So, yeah, just thank you for the presentation and your time and the work. I think there's a lot of value in this. So meeting, our needs here and for others too. So thank you so much.
Well, thank you very much for having me, and thank you all for your continued support and participation in ICGN. We're great to have you guys. Thank you,
Scott, and thank you for making this happen too. Moving on to number 6, items for staff review. Items for future agendas. Good to the order. Call the roll. Anybody?
Anybody? No.
I'll go. I'm happy to be here. All right. A motion to adjourn.
Yep.
All right. Thanks. So let's take a 10-minute break. We'll be back here at 9:03. 10 minutes.